Right now, you have sellers stuck at a price point. They need to get that price point because they overpaid, especially if they've bought in the last 2 or 3 years. They need a price. Buyers right now are saying to themselves, we went through that already. We're not paying anymore. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, if you want to learn how to analyze a property properly in multifamily, stay tuned. This is the multifamily analysis, the do's and the don'ts. Now, we've seen deal analysis over the last couple of years. It's been the Wild West. If you go back 2 years, people were buying stabilized assets. That means assets that were stable, right? The occupancy was above 90%. Markets, rents were where they should be or close to it. They were buying those deals that were stabilized on bridge debt because the debt coverage ratio was not able to get hit at a 1.25. It was insane a couple of years ago. Everyone thought, hey, this is the way you buy deals. This is the way you analyze deals. Well, for those of you that were in the business for years, Jake and myself saw it coming. A lot of people got their pens or pencils and they had pencils down. They made a lot of mistakes. Now, what people should technically do is when you're buying deals, you're buying it on a pro forma. You're not buying on a broker's pro forma. You're buying it on your pro forma. And short-term debt, not saying it's good or it isn't. We haven't used it. We like at least 5-year terms on our deals. It gives us a little bit more time. Now, if you're the type of group that can move real quick and you can anticipate getting a deal done in less than 24 months or 36 months, whatever that timeline is, there's a chance, there's a risk. You run out of time in real estate, you can go bankrupt. So you're buying on a pro forma. Always keep that in mind. But you're borrowing on actuals. So whatever the actuals are, that's what it is. And that's why they had to get the short-term bridge debt, which was risky because they're buying a deal when rates were 3.5%. And all of a sudden within that 24-month window, no one anticipated it. The cost of capital more than doubled. And that's why deals are starting to fall out. And that's the opportunity right now. There's 2 things that you can do to make that deal work. You could put more money down. Your LTV goes from 75 to 65 or 60, or you can drop the price. A lot of people were putting more money down. People weren't dropping the prices. And that's where they are right now. Right now, you have sellers stuck at a price point. They need to get that price point because they overpaid, especially if they've bought in the last 2 or 3 years. They need a price. Buyers right now are saying to themselves, we went through that already. We're not paying anymore. We can't pay pricing from 2 years ago because rates went up from 3.5% to 7%. So that's where we are right now in the market, and it's starting to shift. We've got 3 phenomenal deals on the contract off market from brokers. So when you're analyzing deals, the first thing that you need to do is you need to create a criteria for yourself, what we call the Buri Criteria. And what that allows for you as the investor, it's really important. It's because when you speak to a broker, the broker knows what you're looking for. Our brokers in our market know we're looking for assets that are newer in this part of the market cycle. Anything that's 1980s or newer. Listen, the assets that we have on the contract right now, we have a 2008, 2018, and a 2019, all vintage, all new assets. The deals that we did last year, one was 1985, which was it sounds like an older asset, but this is in really great shape. We did a 2004 vintage and we did a 2006 vintage. So now we're looking for newer assets. That's what we're telling the brokers, right? We want assets. We would love anything. Listen, the third deal we have in the contract right now, it's a 33 unit. So we're telling the brokers if a deal makes sense, anything that's 20 units up to 300 units. How many units can you buy? We love brick exteriors. If you can find brick exteriors, great. Pitched roofs, great. We like the townhome style apartment. It feels like a townhome. We like garages. If you could get garages, home run. And in our market, the delta between the 1-bedroom and the 2-bedroom, it's pretty significant. So if we can have more 2-bedroom units in that property, we'd love it. Let's get a little more granular. Median incomes. What's the median income that you're targeting in your market? For us, we want at least a $50,000 median income, which means it's about $4,000 a month, which means if you take 3 times the rent, they can pay at least $1,200 for a 2-bedroom. It's a little less than 3 times what that median income that they're making is. What's the median income in your market? One other thing that we look for is flood zones. Now, flood zones aren't good or bad per se. I think they're bad. They can be more risky. They're going to be definitely more costly. And if something does happen and there is a big, rain event or something, you may get damage. But it's just a cost. And you have that factored into your underwriting. You don't want to get caught off guard with it. understanding that. A couple other things to mention with your buy right criteria. Do you like amenities? Right now, if we find units that have washer dryer hookups, and in all three of these deals they do, we know we're getting a premium on the market rent. And if it's not even a premium, we know it's an amenity that the residents like. So we're focusing on that as well. Also looking for other amenities. If there's no dog park, guess what? We're putting a dog park. Clubhouses, these properties, two of the properties have clubhouses. We love clubhouses. And if the property is sizable enough, listen, a pool, if it can warrant it, great. Pools are awesome as well. Just understanding it from that perspective. Create your buy right criteria. When you're done listening to this, what are the type of assets that you're focusing on in this market? Now, to analyze a deal, you need the T12, the trailing 12 months. And I know, I'm going to hold up this piece of paper. A lot of times you get you get sellers who are mom and pops. They don't have financials. Try to get at least a rent roll from them. And if you're a savvy enough investor, you can extrapolate expenses. And if you don't know how to do that, well, go back into the market that you're in, go to a couple of community banks, see if they can help you underwrite it with the expenses. We know in our market, certain assets are trading at, expenses around $6,000 per unit or $5,000 per unit. We can plug that into the underwriting. If you can get the rent roll and see where their rents are, and more importantly, what you're looking for when you're analyzing this deal, you're looking for delinquencies. You're looking for how much is actually being collected, what the rents are. And when you look at these rent rolls, you're looking at rent rolls and you're seeing some assets and some units are trading for their market $1,000 for one bedroom, and some are $1,300. Well, you're questioning yourself, why are they at $1,000? There's the value. Market rent is $1,300. You're also looking, once again, like I said, are there any outstanding? That's important because if you're seeing a lot of outstanding, it talks to the quality of the resident. Now, it's not a good or bad deal. Once again, it's just something that you need to take into account. Because if you've got a lot of delinquencies, anything over 60 days, let me tell you right now, you're probably not going to be collecting that rent. You're probably going to have to make, an eviction on that resident, more than likely. That needs to go into your underwriting because that unit is not going to be collecting rent, and you're going to be having charges as far as, rehabbing that unit. Needing to understand that is important. One other thing that you need to ask when you're looking at a property, this is really important, something called the corporate override. When you're taking over a property and you're looking at an asset, how many of these residents have gone in based on the criteria that they used? The credit score, criminal credit background check. Are they being flexible and letting anybody in? Or are they sticking to their standards? Ask that to the broker and to the property management company and to the seller. You'd like to hear that. Now, if they're making exceptions, when you take over the property, you may have some, collections that you have to handle. You may have some delinquencies, some evictions. Just going in open-eyed. Numbers may look great, but there may be a reason why the numbers. There's heads and beds, but are those heads paying? It's really important. Now, as you're looking for the T12 and the rent roll, you've created your buy right criteria. You have to focus on yourself. Is this going to be a joint venture? Is it going to be a syndication? That's really, really important for you to understand. Can I take this deal down by myself, or do I need to raise capital? And what are your goals ultimately? If you're looking to build a smaller portfolio, there's nothing wrong with that. That's what Jake and I's intention was in the very beginning. All we wanted to do was to build a smaller portfolio, a 25 unit, then a 36, then we got a 136. So we had a couple hundred units early on. We never dreamed of scaling. And that component to scale was we were just refinancing money, putting it into the next deal. At some point, we were strapped for capital. That's when we started the syndication process, and we syndicated 3 deals. Those 3 syndications helped us bridge the gap, gave us time to get some more capital, and then we stopped the syndication process, started selling those out, and went back into other deals. Now, as we're reflecting on what I've just talked about, the thing that I want you to take away most from this is when you're analyzing a deal, sometimes we're just focused solely on the numbers. Understanding the area, understanding the true numbers, the expenses. Are they the real numbers? Understanding, are you being conservative? Or as we like to say, Jake and Gino, are you pencil whipping a deal? Which means you're just fudging it a little bit to make it look good. Be honest with yourself. Because when you buy a deal, it's like a marriage. You're stuck with it. And the only way you make money on this deal is to manage it properly and to have some type of exit on the back end, whether that's a refinance or a cash out or a sale. It's the only way you're going to make cash flow. But if you don't manage it properly, and if you don't create a good budget, and you're not conservative, you're not going to hit those numbers. Always ask for the T12. If you can't get it, go to a community bank or even the agencies. They can help you with a mortgage broker. They can help you underwrite a deal. And the rent roll is important. You need those two pieces of information. Get them, start analyzing deals. And underwriting is just like any other thing that you do in life. The more you do it, it's like building a muscle. When you're first starting out, try to underwrite and get as many offering memorandums as possible. These deals aren't going to work. The only two things you can do to make a deal work: put more money down, drop the price. You need a 1.25 debt coverage ratio. Price is too high. I need to drop the price, or I need to put more money down. Those are two things. Now, hopefully in this part of the market cycle, we'll be starting to drop the price. Anyway, I want to thank you for spending some time with us today on how to analyze a deal. If you want to get our book, Wheelbarrow Profits, just email me, gino@jakeandgino.com, and I'll send you a free copy, PDF copy, because that's the way to start buying these deals. We're focusing specifically on buy right in this lesson, but it's all about buy right, manage right, and finance right. Thanks, and we'll see you on next week's lesson. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.